Welcome to another Straight Up Tuesday tip. I'm 𝗤𝗁𝗁𝗁𝗁. With me as always is Mark Ainley, and with us for I believe the third time now, Mike Procaccio. Mike, welcome back to the show.
Hey guys, thanks for having me on. I appreciate it. That welcome always gets me.
It startles them.
I know. Well, we've been doing a lot of these live, so I don't get to do it so often. So now I even got to come in hotter. So for our listeners, if you're not familiar with Mike, he's on our Build Your Team page, trusted accountant of ours. He was also on episodes 198 and 258 if you want to go back and listen. But today it's going to be very geared towards house hackers. I know a lot of you out there, this is applicable. So we're going to talk about house hacking deductions. If you're an owner-occupied and you still have tenants in the unit, what can you write off? So Mike, I'm just going to give you the floor. Go for it.
Yeah, thanks guys. I love house hacking. It's one of my favorite things. And I always get excited when clients say, hey, I'm living in one unit, renting out the other ones. I wish I did that when I was younger as well. It's great, especially in Chicago when there's so many multi-units around. But for the most part, when deducting expenses with house hacking, it's fairly straightforward. And I'm going to give you the example of a 2-flat, and they're equal size. So it's 50-50. So the expenses need to be ordinary and necessary. And what you're going to be deducting is, expenses like mortgage interest, property tax, appreciation, repairs, maintenance, insurance, utilities, advertising, professional fees, getting your taxes done, attorneys, stuff like that. So what you do is you take all those expenses and whatever part relates to the rental, that's a percent that you're able to write off. And that part is pretty straightforward. What happens usually is I get a lot of, questions when people are doing this. So when someone buys a 2-flat, they typically inherit a tenant and then they live in the open unit. So the tenant's fine. They're doing their thing. You're living in the unit and that's typically been neglected. So you're going to paint, you're going to redo the bathroom, redo the kitchen, probably over a year or two while you're living there. And a lot of the questions I get is, what do I do with those expenses? Can I write them off? Is that a rental expense? Since it's not technically for me, it's for the rental in the future, what do I do? Well, that is an improvement to the property. So you're actually adding to your basis of the property by doing that because you're making it better. So that's how that would go. On the other side of the coin, say you're living.
What does that mean? Improvement? Like, is that added the basis? You got to come down a little more third gradish. Like, is that it's going to become a capital expenditure versus a write-off?
So the improvement means you're making the property better. Like paint is technically a repair. Fixing a leaky faucet is a repair. If you're putting in new cabinets, new appliances, all that, you're making the place better and it's going to last longer. So that's what you're doing by making an improvement. And that's going to be, like I said, it's going to be depreciated. If you're living in the unit and then your tenant moves out and the place is available for rent, and while it's available for rent, you go in there and do a coat of paint, that is deductible because that's a current expense. Because places for rent is in a condition that could be rented, and that's how that would be deducted. Another thing we see is deducting our repairs when there should be improvements. So say you put a new roof on and it's like $10,000, they want to write it off all in the same year. That's an improvement. Like I said before, you're improving the value of the house. You're making it last longer. That needs to be deducted or depreciated. And another thing is getting the percentage wrong of the actual part that you're living in. So if it's a 2-flat and they're pretty easy, half and half, you do 50% for your living, 50% for the rental expenses. But if you have like a 5 or 6 flat and they're all different floor plans, you got to figure out the floor plan, you got to figure out your square footage, what you're actually living in and what's actually being rented. And at that point, once you get it right the first year, that just carries over year after year after year. And then I would say the number one biggest thing I get is, I just redid the bathroom in my personal unit. Can I write it off? No, you can't, unfortunately, because it's in your personal unit and it's not a rental unit. So that you can't write off, unfortunately. But when you do move out, like I said, you can add it to the basis of the property because you improved it. So those are, a few of the house hacking things that we get from a lot of people when they have them.
So as far as size goes, it doesn't have to, just say you have a 3-flat and a garden, so 4 units total, but the garden is just like a small 1-bedroom, and like, so you could literally be living in 17% of the place because the other sizes are that much bigger.
Yeah. So what you would do is you would add up all the floor space, divide it out, figure out what you're living in, and the rest of it's the rental.
How do you figure common area? Is that just equally proportion?
Yeah. Yeah. So common area, anything that's done to the common area is going to be for the benefit of the building. So that would be the percentage of the rental. So say it was like 75% rented, that 75% of the improvement to the common area is going to be an expense.
Yep. So does this apply to take like your property taxes, the insurance you pay, just those, those hard costs, same percentage wise, like X amount goes towards the investment side of thing and X amount, the other half goes towards the owner occupied?
Yes, that's correct. Yeah. It's once you get it all done, you put the percentages in and it calculates it out. And it's all fairly straightforward as far as deducting those things go. But it is, anything that gets done to the rental side, say you have someone throwing a ball in the house and they break a window on the rental side. That's 100% deductible on the rental, obviously, because you're repairing the rental property. So not everything is. So if it is happened to exclusively to the rental side, that's 100% rental expense.
How does this is just crazy? How do they know that you're living in the garden? Is that like documenting you're documenting the property as owner occupied, or is it just your address on the return is the property address and you have to justify that? Like how does that get cleared up?
Typically, yeah, your address would be, that'd be your tax home would be the address. And there's really not like a formal reconciliation process with that. But, it is, you're living in the unit, you're also renting it out. You would have your home address and your rental address be the same address. So there would be, some need to separate that out.
Yep. And so for our listeners going through this right now, is there any advice you can give them on maybe timing on some of these repairs or improvements? Like, is there anything this all makes sense. So is there anything that they should be aware of to make sure that they're maximizing their return here?
I think the best thing is, if you are going to, a lot of people, house hacking is kind of like the first step in real estate. So you get the 2-flat, you inherit the tenant, you fix up the first unit, and then the eventual goal is to move out and go on to the next one, right?
Yep.
So if you have the means, I would suggest maybe getting the property all set up and then move out to the next unit, your new house or whatever it is, your next house hack, whatever it is. And then while it's available for rent, if you need to do a few more touch-ups, if you need to do a few more things, those would be current expenses. So it's available for rent. The property is in a condition that could be rented. You're living somewhere else. You could use that to, maximize your deductions there.
Okay. Makes sense. But and then one other question, like whether it's a house hack or not, who keeps track of like adding to the basis? So let's say you buy something for $500K. 2 years later, you do a roof. 2 years later from there, it's, the hot water tank. Like I know you as the investor should be, but like, that's not getting documented on your returns at all, right? No, you go to sell 10 years from now, or is that actually on there?
It's on there. It's a depreciation schedule and gets carried forward every year.
Got it. So you actually add all those expenses to the depreciation schedule.
Correct.
Shows how little I pay attention to these things.
Now, to clarify, because I think it's a huge thing as well too. So say you bought that place for $500,000, you put your $10,000 roof on. When you go to sell, you would pay tax, and say you sold it for $600,000. You're basically cap gain gap. I'm not going to get technical with depreciation, recapturing all this stuff, but technically you're now that difference is $90,000, not $100,000. Correct? As far as
if you go to sell and it's a partial, so you're living in one half, renting out the other, there is going to be depreciation recapture. So not to get too much in the weeds, but yeah, so it would be. So it's like basically
this is like the basis before depreciation recapture, though.
Yeah, before the basis, though, or before the recapture of that.
I'm sorry. Will you repeat the question?
So just easy numbers. You bought it for $500. You put a $10,000 roof on. You sold for $600. Your real taxable gap there is $90,000, not $100,000, because the $10,000 roof, you basically put that on top of what you originally purchased it for. Correct?
Well, it depends how much was depreciated of the roof and how long it was. So it's a little more complicated than that. But yes, I mean, technically you'd be depreciating out, then you have to recapture that.
All right. So if you sold it, you put the new roof on, you sold it 2 weeks later, it depreciated. I just want to, because I think it's really easy for you to put those two things together. But from a everyday person out there listening, I want them to be able to separate, like, all right, every time I'm not able to write this $10,000 roof off, or I'm not able to write this $40,000 repair off, but this is actually going on top of my actual purchase price, which will work hopefully for me at some point when I have a potential taxable event when I go to sell.
Yeah, so that roof is going to increase your basis. So the basis is what your property costs plus any improvements. So that $10,000 roof would increase your basis, and that would make your profit technically less.
And so when you go to sell your property, a lot of people go right back to, oh, on my closing statement, when I purchased this 6 years ago, I purchased it for X amount of dollars, and now it's worth this, and that's. But they're not. A lot of people don't account for. I put in this many. I added this many improvements that went on top of that. So that's why I just want to make sure everyone's clear on here.
That's why it's really, really, really important to talk to a tax advisor prior to selling. We see a lot of people who do this, and before you do anything, I mean, it's a small fee. Talk to them. Make sure you're on the right track. That's all it is. I mean, we're not.
I'll encourage. So let me tell a quick story here. A couple of days ago, I had a guy. He's been managing us for 5-6 years, and he had he actually has these properties paid down. However, he got them paid down, but they're free and clear. And I think he owned them for 15 years already, but he aggressively paid it down. And he's like, yeah, I won't have this, I won't have that. I said, man, you're going to recapture 100% of all your depreciation when you go to sell. So make sure you're calculating that. He called up his CPA, his accountant, and basically he didn't realize he was going to take away probably about $75,000 between the two properties, less than he thought he was on the surface. So just to kind of validate, like, if you're, yes, you can talk to your real estate broker, you can talk to someone like me, but at the end of the day, it's your CPA and how they've done your taxes the last X amount of years will ultimately be determining how much you're going to walk away with if you do choose to sell.
Yeah, I'll go even one step further. I was trying to buy a building from a seller, and I ended up not being able to because, let's use your example. He bought for $500 10 years ago, right? It's now worth $1 million. He refied at some point. He refied it up to like $600-700. Right. So he was going to walk away with $300K from the sale, roughly, right? Like $1 million minus the 700. But like his gains were also going to be like close to that number. Like it was a more extreme example than the numbers I gave. But he had refied. So he'd already taken the cash. And then all the gains and all the depreciation recapture from the time he was going to sell was basically what he was going to gain from the sale.
Yeah, and
like he couldn't sell. Like he wasn't going to make any money off it, even though on paper it looked like he was making hundreds of thousands of dollars.
That's such a good point, Tom.
Yeah, if you refi till you die, if you're one of those guys who just keeps refining, and then you go to sell, like you still have that original basis. Like that's what you're getting off of. And so if you're not getting that many proceeds at closing because your mortgage balance is so high, like you might be in a spot where you're coming to the table with money, which is insane.
Yeah. So another thing to consider is, I'd say like once or twice a year, we have clients come to us, and mom's getting older. She's had a rental property for 30 years. It's all paid off, and they, to clean things up before she passes, they want to sell the property, get it off the hands, get it all sorted out. But the problem is, mom is going to have to pay a huge amount of taxes on that. If they wait until mom passes, they get what's called stepped up basis, where the basis of the property will pass on to the kids at the price of the property at the time of death of the mom. So that's something to keep in mind. So that's a way of like,
if mom bought the property for $100,000 and it's worth $1 million now, basically the kids or the next in kin get the property, their new basis is $1 million, and all that $900,000 of potential risk of being taxed on is gone.
Correct.
Huge. A lot of people don't realize that.
Yeah. They think they're sneaking a fast one and like getting it all cleaned up before, but it really costs a lot.
But you can refinance that for mom, pull out cash for mom, and then if she passed away, she wouldn't even have to pay that back either.
Well, that's not my territory, but yeah, it's
All right, man. We've zigged and zagged all over the place, but had a lot of value here. So, Mark, let's wrap this up with our Chicago fact. Who we got? Who we playing for?
All right. Omar Menino. Omar, if Mike or myself gets this question right, you get a $50 gift card brought to you by our guest today, Mike Procaccio from Pro Financial.
Mike is playing to make himself more poor. I like it.
Yes.
All right. We'll go with architectural question here. We haven't done one of these in a while. You guys, it'll be 4 options. You guys each get a shot, so we're going to be 50-50 at the end of the day. This Chicago landmark was built in 1889, and at the time, it was the largest building in Chicago. And your options are the Auditorium, Fort Dearborn, Sears Tower, Water Tower.
I'm going to go, I think I go Water Tower.
Give me the 4 options again, real fast.
The Auditorium, Fort Dearborn, Sears Tower, Water Tower. Built in 1889.
Oh, well, it's not Sears Tower.
It's either Fort Dearborn or Water Tower, I would guess.
I don't even know what Fort Dearborn is. I thought that was a fort from.
I think it's like one of the original stars on the Chicago flag.
Yeah, no, it is. All right, so I'm saying the Auditorium.
The Auditorium is correct.
All right.
There you go. So Water Tower survived the Chicago fire. That's why I thought you guys would get that.
But that's so small, though. Like that couldn't have been that big. I guess to me, like that's a pretty small structure.
Yeah, but 1889, stuff wasn't that big. Auditorium's not that big.
I don't know what the auditorium is.
It's on Michigan. Like it's like I think Roosevelt owns it now, like the university.
Oh, I know what that auditorium building is. I actually went to an event there. It's actually a really cool building.
It's really cool. One of the cool facts I'll spit out here is it actually had air conditioning in 1889, which was like state of the art. It required 15 tons of ice a day to run the AC. Wow. 15 tons of ice building. A day.
That's crazy.
The foundation of that building is like 15 feet wide at the bottom. It's crazy, the stone there.
Yeah. All right. Nice work. Mike, were you throwing it so you didn't have to give out the 50 bones?
No, I honestly thought it was a water. We took a
field
architecture cruise with the family this summer, and I was like trying to go back, and I was like, it's definitely one of those two. But yeah, no, I'm glad you got it right.
All right, awesome. All right, Omar, congrats. You get $50 gift card brought to you by Mike and his Pro Financial Group. So if you're listening to this, give us a quick 5-star review. If you're watching this, subscribe. Leave a comment. So if you leave a comment, leave a review, you get your name entered into the Chicago Fact end of the show. So Mike, thanks for coming on. Tom, thank you. Listeners, we'll see you on Thursday.
Thanks all.
Thank you guys.